Okay, well, hello everyone, and thank you for joining us for today's webinar, where we'll be focusing our attention on inflation and applying the right tools to help your organization during an inflationary environment as we're seeing today. I'm Dana Vosberg, Managing Director of Advisory Services, and I'm joined by two of my colleagues today, Nick Centineo, a Senior Investment Consultant and Endowment Foundation Specialist on our Advisory Services team, and Jake Simoniak, a Senior Research Analyst in our Global Strategies Group. Now, before we get started, if you have any questions throughout the webinar today, please feel free to submit them at any time using the Q&A option located at the bottom of your screen. When we conclude today's prepared material, we'll spend any remaining time answering questions that have been submitted. And if we're unable to answer your questions due to time constraints, or maybe we'd like to do a little extra research for you, we'll personally follow up with you after the webinar. For your convenience, a recording of this webinar will also be available shortly after we conclude today. So I'd say that the August inflation data was released earlier this week, and it certainly remains stubbornly high and higher than many had forecasted. I say the market reacted negatively to the latest data, and I think largely due to anticipating what the Fed will have to do to combat the inflation. So to state the obvious, inflation remains a big and important issue right now. It's important because it impacts all areas of the market and the economy. Everyone feels it in some way. And because it's so impactful, it requires planning. And whether for your individual finances, just personally, your own personal finances, or for organizations, managing operations, with an effort to benefit an important cause, not planning properly can cause organizations to run the risk of coming up short on goals. So today we'll be covering the inflation topic from a number of angles. How did we get here, and what level of inflation are we experiencing today? Spoiler alert, it's kind of high. What's currently being done about it, and what's our perspective on inflation as we look ahead, and most importantly, what should nonprofits be doing to manage this challenge? So Jake, let's just start then with you and help us level set a bit here. How did we get to the point of multi-decade high inflation?
Yeah, so I think I would start by saying that inflation is notoriously difficult to predict. So one of the things that you can do is kind of take a step back and try and gain some historical perspective about past inflationary periods in the United States. And I think the two periods and potentially the third that really stand out, kind of the 1940s into the 50s, the 1970s, and then the period we're in now. And when you take a look at those periods and you think about what you really saw, I would tell you that there were three features prominent in all of those episodes. The first was a fiscal shock that changed demand and increased liquidity in the system. The second was a monetary shock, or some sort of significant change to monetary policy. And the third was some sort of exogenous shock that really, I guess, had the effect to take supply and demand out of balance. So when you think about what you saw in 2020, all of those events were present. You had a massive fiscal stimulus in the United States. You had interest rates effectively taken to zero. And the exogenous shock is obvious. It was COVID, and that had a dramatic shift in demand patterns in the US and the ability of supply chains to supply those demand shifts. Okay. So that kind of takes us to where we are now.
Good. Well, now over to you, Nick. I would say, I think people tend to be aware currently of market volatility and how that impacts portfolio. Like the values goes down, right? We've been seeing that, at least as far as the reaction to, inflation data and what the market, how the market responds. But what impact does high inflation have directly on an investment portfolio and managing a portfolio?
Yeah, sure. I mean, in a nutshell, inflation is an important input when you're deciding on your asset allocation and your spending rule. Every portfolio is a little different, but my go-to example is a common one, I think. So suppose you have a true endowed portfolio. Suppose its goal is to be perpetual and to provide equal support for current and future beneficiaries. Then this would mean, at the very least, this portfolio will need to maintain its real purchasing power after inflation and after funds are withdrawn to support whatever programs it's meant to. And so typical assumptions for planning for a portfolio like this are maybe 3% long-term average annual inflation and 5% long-term annual withdrawals. And so that would mean your return target is 8%. 3 plus 5 makes 8. If inflation is higher than assumed, and if the goal is still to maintain real purchasing power over time, then that differential has to be made up somewhere, either through higher returns or lower withdrawals, at least on average over the long term. And so because this dynamic plays such an important role, inflation is also one of those factors that MIFA requires organizations to consider. And of course, MIFA is the nonprofit endowment law that most states have a version of that governs the management and the distributions of endowment funds. And so basically, inflation is very important. We think of it as one of the three core planning assumptions for nonprofits, alongside withdrawals and returns. And so the impact from inflation can be quite large. And one more, I think, underappreciated aspect of inflation for you fundraisers out there, it has a big impact on your donors too. Inflation can put a huge damper on a donor's financial confidence because, unlike some other things, it's very visible, and it's something that no one can really control. You can't control what price you pay for your living expenses. And so while giving was very strong in 2020 and 2021, it remains to be seen what the impact recent events will have on giving in 2022. So that'll be an interesting effect also.
Great. Well, and thanks both of you for a good background there and sort of setting the foundation. I think it's fair to say that inflation can be, a real challenge in a variety of ways. And I mean, many are seeing that and experiencing that certainly firsthand. So Jake, what's being done right now by the Federal Reserve to get inflation under control?
Yeah, so I guess I would highlight three tools that the Federal Reserve is using at this point in time to try and combat inflation. The first one I'd point to is forward guidance. And what I mean by this is the Federal Reserve, its members are out talking, having press conferences, speeches, and what they say, as we saw the other day, can move markets.
Right.
And to the extent that they can kind of guide the market towards where they want it to go and have the market do some of the work for them, that's something that we can continue to expect out of the Fed. The most obvious thing that we see is hiking the federal funds rate. So we've seen several hikes, and we should continue to expect hikes, especially as the U.S. economy remains fairly resilient. I would tell you that we are in an environment right now where the stronger the U.S. economy remains, the more we should expect the Federal Reserve to hike. Finally, the biggest change that we're seeing now is we've been in a period where the Federal Reserve has been expanding their balance sheet by buying assets through a process called quantitative easing. That's now reversing, and the Fed is going to attempt to shrink its balance sheet through a process called quantitative tightening and effectively remove liquidity from the financial system and the economy.
I think, so we've talked about kind of how we got here, and then some of the things right now that are some of the, the methods that are being used to get some of this under control. But I think everyone wants to know, really, what does the future hold? So, that's where are we headed? And it's a difficult time, so people are really eager and sensitive to know that. But what's our view on where inflation is going then?
Yeah, I mean, it's the $1 million question right now. And I think there's two ways to look at it: cyclically and secularly. So from a cyclical standpoint, I think there's a decent chance that we've seen the peak in headline inflation in the US. The pullback we've seen has been primarily driven by goods inflation rolling over. The issue that we see now, though, is that when you dig into the data, core inflation continues to move higher, and specifically services inflation. And that tends to be stickier. So particularly things like wages, with the job market remaining strong, the labor market being tight. And also, it's also significantly driven by shelter prices. So you think about what has happened with home prices over the course of the last year and a half, that works through the system with a lag. And that's going to continue to pressure core services higher. So despite the fact that, again, cyclically, headline inflation has probably peaked, the underlying data is a bit more concerning for now, and it's continuing to move higher, which is why the Fed feels that they have to continue to act aggressively.
Yeah, I think those are real good points, Jake. It's the secular part that you mentioned that is really interesting to me, sort of as a nonprofit planner and as a big picture guy. And by secular, what we mean is, what is inflation going to be over the long term, over the next maybe 10 or 20 years? And again, to me, it's helpful to have a little bit of a historical context behind this question. Annual inflation averaged about 7% in the 1970s. It averaged about 5% in the 1980s. It was 3% in the 90s. It's about 2.5% in the aughts. And then it's been less than 2% in the 2010s. Inflation has basically been falling for 50 years. And so wherever we're going from here, know that it's coming off of a very low base. So that's issue number one. Now, issue number two is sort of what trends or factors drive this secular trend. Economists have theorized that there's several big picture trends that have helped to lower inflation over the past 50 years. And the worry today is that many of them may be reversing or maybe even stalling. So the first trend is globalization. And so in the 50 years prior, globalization brought cheap manufacturing and incredibly lean supply chains to the fore, basically holding down prices for a lot of consumers. But over the last 50 years, you've likely heard the last few years, you've likely heard stories about how globalization is reversing, as political winds have shifted and supply chains have really turned out to be a lot more brittle than expected in the midst of a pandemic and now a war. So to many companies, a more expensive but more resilient supply chain may be preferable going forward, and that could be something that increases inflation. The second trend is labor markets. So millions of low-wage Asian and Eastern European workers have held down global labor costs over the last 50 years as they've joined the global economy. Immigration into the US has had the same effect in terms of more local labor. And we've benefited also from pretty attractive demographics too when it comes to population growth in the US, with baby boomers reaching their peak working years over the last 50 years. And so a knock-on effect for all these things has been lower inflation. Today, all these factors are changing. Overseas labor is getting more expensive. Immigration levels have fallen in our country. Our country continues to get older overall and on average. And that adds up to fewer workers, which could force higher wages and higher inflation. And then the last trend that is notable, I think, is energy. Energy is an important input into just about everything. Coming off the oil price shocks of the 70s that Jake mentioned, Americans enjoyed what was really a prolonged period of very low energy prices, stemming from a lot of the investments that the companies made in response to those higher prices in the 70s. There's been exceptions in certain years, certainly, but energy prices were pretty flat, like throughout the 1990s, for example, and they actually fell throughout all of the 2010s. And so the question is, what will energy look like in the future? And when you think about that, renewables provide a lot of optimism. For those who have invested in renewables, there's certainly hope that they'll pay off in cheaper energy in the future. But on the flip side, aside from maybe the fracking boom, there really hasn't been much investment in traditional energy sources in recent years. And that creates a risk of shortages and supply shocks, and that doesn't bode well for long-term inflation. So when you take all this into consideration, these three big picture secular trends and how they're changing, to me, the balance of risk is toward higher inflation longer term. And again, it doesn't take much to say that, because we're coming off such a low base, but it's plausible that the secular trends could favor higher inflation going forward. And so it's important to know that going in.
Nick, if I could, I'd add on to that last point you made too. And I think that lack of investment that we've seen in traditional energy sources, you could kind of broaden out across tangible assets in general. When you think about where money has flowed over the last decade plus, it's been share buybacks, it's been financial engineering. What it hasn't been is physical infrastructure in the US. To the extent that you want to build out the energy grid or pursue green energy, we haven't seen the investment in mining capacity, in mining equipment. To the extent that housing is an issue, we haven't seen significant investment in housing supply in densely populated areas. So that lack of investment that you talk about with energy, that's kind of pervasive across different verticals, and it'll be interesting to see how that plays out over time as well.
Yeah, great point, Jake.
Yeah, and I think, I mean, really a lot of really good information there, and I think certainly pointing to a perspective that is that we would see higher inflation at least for a period of time. But I think great point, Nick, as well, is just as far as when you think about the context of where we're coming from. That's not really hard to have a higher inflation level than what I guess we've been accustomed to, certainly over the last several years or last couple decades. But based on what was just covered then, so outline, Nick, what this might mean for nonprofits. They're, a direct nonprofit operating and their own outlook and plan going forward.
Yeah, well, we think that nonprofits need to be at least prepared for higher inflation. Nothing is a given, but part of being on a governing board and having a fiduciary duty to your organization, as I'm sure many on the call do to their organizations, part of that is prudently considering the risks that your portfolio could face. And as we've outlined, it's plausible to think that inflation over the next 20 years could be higher than it's been over the last 20 years. Again, we're talking long-term things, we're talking big picture, because really anything can happen in a year or two. But over the long term, it's worthwhile to start planning today about the possibility for higher inflation. And so our main recommendation is to plan for this risk. Speaking from experience, we've helped a lot of our clients do just that. And it's filtering down into a lot of the different decisions that nonprofit leaders have to make. Planning for your investment portfolio is an obvious example. Organizations are also planning for changes to their operating costs, their labor, materials, what have you. And they're planning for how to talk to their donors. They're considering how their donors' finances are affected by inflation and adjusting their cultivation efforts in response. And so the big picture is start planning now.
Good. Yeah. Well, in the title of this webinar, we mentioned 3 tools. So there are tools that you can deploy from a strategic planning standpoint. I think some of the things you just mentioned there, obviously, Nick, and then there are also tools within an investment portfolio. So Nick, it's like build on that a little bit, and what are some key tools then that nonprofits should be using?
Well, when we're talking about an investment portfolio specifically, nonprofits have 3 primary tools at their disposal. Okay, so number 1 is your spending rate. Going back to the example we had a few slides back, spending is one of the inputs into that equation we showed. So your return minus the rate of inflation is your spendable capacity, if your goal is to provide perpetual support. And so if inflation is higher, you could choose to reduce spending to offset that. Now, that is not always palatable or possible, but it is an option depending on your priorities. And a lot of times we'll help to model out the impact of such a decision to try to show the trade-off between basically spending more or trying to grow more. It's an important trade-off that every organization has to consider. Number 2 is to increase your risk tolerance in your investment policy. Now, the goal here would be to generate higher long-term returns. And this is done via a higher allocation to growth-oriented assets like stocks. Now, one of the best ways, this is going to be the understatement of the webinar, but one of the best ways to combat inflation is to grow your capital. And nonprofit investors are uniquely positioned to take advantage of this because most portfolios are perpetual. Many organizations can afford to be patient. If, for example, you don't need all your money at once, if your withdrawal magnitude is fairly moderate from year to year, and if your spending rule is based on a % of your portfolio, and you can be okay with some variation in that level of spending from year to year. No one likes volatility, But endowments especially have a lot of built-in advantages that let them use it as a tool. So I guess the trick is just making sure that it's suitable for you. And again, this is where we'll help with projections showing the range of potential outcomes under different scenarios, and that's helpful to the clients that we work with. You really wouldn't want to make a decision like this without carefully weighing the pros and cons of more risk in your portfolio. And then number three, the third tool, it's probably the most attractive tool, but maybe also the hardest to achieve. You can try to beat the market. You can generate alpha above and beyond what the market gives you. You can focus more on your absolute level of return instead of your relative return. For example, by trying to protect as best as possible when the market is going down. And you can adjust your holdings to account for different environments, for different investing environments. For example, in a high inflation environment, it might make sense to be selective. Own certain securities that are poised to do better than others. At Manning & Napier, we have expertise in all these tools, including actively managing our clients' portfolios according to what the market offers us. And actually, Jake is part of the team that makes those day-to-day decisions. And so, Dana, maybe this is a good segue into what we're recommending in portfolios today.
Yeah. So three tools then, excuse me, that Jake, that we would be using from a portfolio management standpoint that would be worth deploying.
Yeah. So when I think about what we're trying to do and kind of how you want to navigate an environment like this, I think terms like uncertainty that you've used, risks of higher inflation, I think those are the things that we're focused on at the moment. So first and foremost, I think focusing on asset allocation and proper positioning in an environment like this is critical. You have to be able to take a step back, look at things that you think might be or might not be changing in the market, and adjust your allocation to stocks, to bonds, to cash, to alternative investments, if that makes sense for you. But you have to be able to take a flexible approach. I think in an environment that's as uncertain as this one as well, unfortunately, volatility is just going to be a feature. When you look back at the last decade, things have actually been fairly calm. Markets have not been terribly volatile outside of brief periods, but that might be changing now. The Federal Reserve is no longer the tailwind that it was. Rates going up, as we've seen, tend to be bad for certain sectors of the market that may have performed better over the last several years. And you have to be prepared for that volatility. Now, as uncomfortable as that can be, the other side of that coin is that if you remain disciplined, if you remain flexible in your approach, you're also going to be presented with opportunities that maybe you haven't seen in a number of years to gain exposure to parts of the market that maybe people aren't as focused on, or to certain types of companies that maybe were outside of your valuation disciplines and you didn't feel comfortable kind of pursuing investments in those at the time. So if you're active, if you're flexible, and if you can stay disciplined in your approach, this is a time to find opportunities. And I think specifically from our standpoint, in an inflationary environment, we're particularly focused on trying to find companies with pricing power, strong competitive moats, healthy balance sheets. And that doesn't necessarily stray from what we do here at Manning & Napier in more typical times. But again, it's important to stay focused on what we do and what we do best, even during periods of volatility.
And Jake, are there any certain areas, I guess, sectors that might come to mind as far as that could benefit from an environment like this?
Yeah, I mean, historically, in an inflationary environment, one of the features you see are rising yields. In an environment like that, hard assets tend to do well, and longer duration assets, like certain parts of the, call it the technology sector, tend to struggle. And that's kind of what we've seen. I think the environment is a bit more complicated now when you consider where we are economically as well. Some of the sectors that tend to do well in a more inflationary environment also struggle later in an economic cycle in the type of environment we're in now when growth is slowing. So again, I think it's a matter of understanding that we're in a volatile period. Quite frankly, there's going to be times when the goal is to preserve capital as opposed to pursuing strong absolute or relative returns. And you just have to be cognizant of where you are in the cycle.
Yeah, I'll just tack on. I think those are great points, Jake, and because the first bullet on here is, focus on asset allocation and proper positioning. And from my experience, and I think this sort of underscores your points too, probably the number one tool at the disposal for nonprofits is your asset allocation. The number one tool enabling you to achieve your goals over the long term is what you decide in the guidelines in your investment policy statement, and then the day-to-day allocation that depends on what the market is offering you for opportunities. There can be very long-term periods of time, data has shown, where certain allocations might fail to beat inflation over as long as 10 or 20 years. I'm thinking more towards like a fixed, a portfolio where your allocation is locked in and fixed at one point in time. The traditional 60% stock, 40% fixed income portfolio would be an example of this. There's periods of time where that 60-40 portfolio might fail to keep pace with inflation. So having the ability to be flexible with your asset allocation at a very high level can give you a huge advantage over others in an environment like this, if we are indeed entering a period of much more difficult returns.
Right. So if I can summarize, I think some of what we've covered here and some of the key points. I mean, managing portfolio spending, portfolio allocations, and obviously having an investment policy that's aligned with goals, along with active management and flexibility. It's important for all of those areas to be in good order, so that you can manage through an inflationary period. And we obviously can't know with certainty what will happen in the future. So it's important to be prepared and gain an understanding about where things might go from here, have that context, and then, apply and take the next steps and put that in place. So I think maybe as a bit of a way to wrap up our sort of prepared material, Nick, can you walk us through, I think, an example of how ideally you want to see this play out for a portfolio?
Yeah, absolutely. Manning a peer is lucky enough and proud to have a very long-term track record, back to 1973, actually. So a period encompassing lots of different types of inflationary environments. So that is a great example. You can apply that to a hypothetical endowment situation and see how it would have turned out. And that's actually just what we've done on this slide. So let's suppose you had a $1 million endowment starting in 1973. Okay, so suppose you wanted to have 5% withdrawals each and every year. Suppose you applied the actual net of fee long-term growth track record, our track record, which is a composite of our actual client returns. And suppose that was your track record. And then suppose you wanted to compare that against a benchmark, a market-based benchmark appropriate for like the long-term growth strategy. And then suppose also you wanted to track how inflation would have done over that time too. And so the results are on this slide. So the growth for this hypothetical endowment, it would have gone from $1 million in 1973 to about $6.9 million at the end of June this year, 2022. And over that entire time, cumulatively, you would have withdrawn about $9.7 million out of it. So that's a lot of support that an endowment can provide an organization. The benchmark returns, that $1 million would have grown to about $4.9 million at the end of June, and the withdrawals from that portfolio would have been about $7.7 million cumulatively. And then I think this is the most important aspect here: inflation. If you take $1 million starting in 1973 and just grew it by the actual rate of inflation over that entire about 50-year time frame, the inflation adjusted value would be about 6.9, almost $7 million at the end of June. And so the long-term growth outcome has just about matched the inflation adjusted value. It just about perfectly kept up with inflation over this entire time frame. but you've also supplied withdrawals of $9.7 million. This is an example of, I think, how an endowment is supposed to work. You know, when you think about the endowment model of a perpetual portfolio, this is how it's supposed to work. And so we're proud of that track record. And I think, Dana, this is just an example of how something can work out despite lots of different market environments.
Great. Well, thanks, Nick and Jake, for a lot of really good information there. So with the time remaining, we can answer some of the questions that have come in. And if you haven't submitted a question yet, please feel free to do so, because we'll cover those questions now. We have a couple here that we can hit on right now. One question about the Inflation Reduction Act. So I guess, Jake, you just maybe summarize the impact of that. Is that something that is, maybe going to have a real meaningful impact on inflation going forward?
Potentially, but also potentially not in the way that we might think. When we get back to the framework that I kind of talked about in assessing inflation at the beginning, fiscal policy, monetary policy, and changes in demand patterns. When you look at the composition of the Inflation Reduction Act, we don't necessarily see anything specifically targeted at addressing inflationary pressures until about 2026, when the bill aims to deal with prescription drug pricing. Before that, there's actually a decent increase in fiscal spending specifically geared towards subsidies for green and renewable energy. Now, to the extent that that can happen fairly quickly and it increases productivity, it has the potential to bring inflationary pressures down. I think the odds of that happening are potentially fairly low. So in the interim, unfortunately, it could have the effect of potentially increasing inflationary pressures, but again, not entirely certain. And I guess I would leave it at, I think the short-term impact in terms of actually reducing inflation is likely to be fairly muted.
Well, so I guess somewhat related then, another question, is there anything more government policy can do or should be doing to address inflation?
Yeah, again, when you think about inflation, fundamentally, it is an imbalance between supply and demand. So I think the Federal Reserve right now is trying to combat inflation on the demand side by slowing economic growth. As far as addressing the supply side, to speak very broadly, I think that policy should probably be focused on alleviating bottlenecks and kind of facilitating the clearance of supply blockages or enabling supply to come on in areas where we need it, maybe more so than it has more recently.
Okay.
So a broad answer, but I hope that answers the question.
Yeah, I think that's good. And something that's maybe it's related also, but as somebody asked about, will the recently announced student loan forgiveness program make inflation worse? Because I know that was sort of part of the news, is that, okay, this sort of feels counterproductive to some of the other, bills that are trying to combat some of the inflationary pressures.
Yes and no. I mean, to the extent that it increases consumer spending, I would say that it could potentially have upward pressure on inflation. But I think the important thing to remember here too is that a lot of these loans haven't been serviced for quite some time anyway. So I don't necessarily know that it's going to cause significant changes in behavior, or that it affects a large enough number of people to such a magnitude that we're going to see, anything close to the type of stimulus we saw in 2020. So I'm inclined to say that the inflationary impact, while it might be biased to the upside, is probably going to be minimal.
Mm-hmm. Well, kind of a question that comes to mind actually for me and for Nick, I guess, just with your experience working with organizations so far this year, as we've seen, just a spike in inflation, is there anything that you're noticing, or at least from direct experience, sort of that organizations have done that has surprised you, or at least is I think taking into account some of the things and the tools that you've mentioned, I guess just anything that comes to mind?
You mean like in regards to like combating inflation?
Yeah, I think just interesting. This is something that, to your point earlier about
Yeah.
we've been in a world and in an environment where inflation is just consistently low. Now
Yeah.
it's jumped up. So I guess anything there just comes to mind.
Organizations aren't holding back. I think they're doing a great job getting out there, getting their message across. And so the first level of interaction is sort of with donors. I think they're doing a great job of interacting with donors, number one, because there has been sort of a drop off in donor interaction the past 2 years. Just,
Right.
in-person things are difficult. They've gotten better. So I think engaging with donors has been great, and that's paid dividends for organizations who have really focused on it. And then I think more of, like, in terms of charities, social services organizations, the need has become greater out there, probably because inflation is impacting a lot of people's finances. The prices of food, especially, are something that I'm thinking of. And so organizations that play in this area, they're all over this,
Mm-hmm.
and they want to help. They're turning this into an important selling point to their supporters, and I think that's a good way to approach this problem overall, because a lot of these things can't be solved just with investments or an endowment. That's great to have over the long term, but some things need to be solved more directly through grants and through more donor support. And so a lot of organizations recognize this, and I think it makes sense to plan for that going forward.
Yeah, no, that's good. Right. I think being proactive rather than, expecting the problem to go away, in a sense. Right.
Yeah.
And so the organization has to be very active there. So one more question here. Good. This is one that we hear a lot, and not just related to this webinar, but in general. Are we in a recession? That's something. That's so Jake, you can tackle that one maybe.
So I feel a bit like this is a cop-out answer, and I don't mean it to be, but I think the honest answer is that we won't know, because definitionally, someone has to look back at the data and be able to tell us. I think what I can say with confidence is that the US economy is slowing. It's been fairly resilient, and it's actually, depending on where you look, it's slowing. It's not accelerating to the downside right now. It's been kind of a slog, but economic growth is slowing. And what's interesting about that is, typically when that has happened, the Fed has been there to provide what we call countercyclical policy and to actually try and support growth. With inflation where it is right now, we're not going to have that support unless we see a significant downtick in inflation. So as it relates to investments, I think the important thing to consider is that you're not going to have the Fed there to support you, at least in the near term, at a time when revenue for a lot of companies that, I guess, are exposed to the economy, which is, obviously most companies,
Right.
are going to be seeing pressure on their top line.
Right.
So from an asset allocation standpoint, from an investment standpoint, that's certainly something that we're thinking about with regards to positioning.
Yeah. Well, good. Well, that's the last question for today. Thank you all for attending today's webinar. As a reminder, a recording will be available for you to access at your convenience. And if we didn't have a chance to answer your question during the webinar, we'll follow up personally to answer that question. If you're interested in learning more about the services we provide nonprofit organizations, you can schedule a call by visiting the link you see on the screen there. You can also contact your Manning & Napier financial consultant if you're currently working with one. Also, please register for the content Manning & Napier creates, covering a broad range of planning and investment related topics. We produce a fairly steady amount of good material specific to nonprofit organizations that you may find interesting and helpful. And finally, we do have a survey after we wrap up here that you'll see. So please take that survey and give us some feedback. So on behalf of my colleagues, Nick and Jake and Manning & Napier, thank you and have a great day.